This video supports you to get financially literate. We're going to cover income, expenses, assets, and liabilities. We're also going to explain things like tax, superannuation, investing, and how you can best manage your money. What we cover here today will be set in Australia for the 24-25 tax year, so please keep in mind that specific details may change for wherever or whenever you are watching this. I'm not a trained financial advisor. This is just general advice based on my experience as an employee and a freelance musician. In our culture, we are conditioned not to openly discuss money with others. However, it's extremely important to have healthy conversations to support your own financial literacy and literacy for those around you. However, please keep in mind that everyone has different financial situations and varying levels of advantage and disadvantage. So try to have emotional awareness, empathy, and understanding for others when you're having discussions around money. So to better understand money, we need to consider these 4 categories: income, expenses, assets, and liabilities. Income is the money that you make. You can make income by being an employee in a workplace, or by selling your own products or service as a business, or from assets that you've invested in. Expenses is how we label anything that's taking money away from you. These can include living expenses, tax, work-related expenses, expenses from liabilities, and money that you spend for things you want in life. We call this discretionary spending. Assets are resources that can make money or be converted into money. These could include superannuation, shares, property, or business. Liabilities are debts and things that take money away from you. This could be credit card debts, car loans, home loans, student university loans, and tax debts. Now let's look at pay slips. A pay slip should show you your hours worked, the rate that you've earned per hour, the gross amount earned before tax is taken out, the actual tax taken out, and the net amount earned after tax has been taken out, and superannuation contributions. You should get into a habit of always checking your pay slip, especially if you work casually. In many businesses, the pay process goes through 2 or 3 people, and what may seem obvious to you and your supervisor may not make sense to those people processing payroll. So always check for mistakes and address these with your supervisor in an assertive and empathetic way, so you maintain positive workplace relationships. So now let's understand what gross, tax, and net mean. So to understand this, we need to discuss income tax. Every individual who works pays tax. Tax is money that is taken out of the income of individuals and goes towards government services and infrastructure, such as schools, healthcare, roads, and other government initiatives. Usually, tax is talked about in a negative light, but just remember it is good to be paying tax. Your tax contributes to society, and it's also illegal to avoid it. How much tax you pay depends on how much money you earn in the financial year. In Australia, the financial year is between the 1st of July through to the 30th of June. Once you've worked out how much money you have earned in the financial year, we now look at the income tax rate to work out how much tax you need to pay. In Australia, you can earn up to $18,200 per year, and you do not pay any tax. If the money you have earned goes over $18,200, you start paying income tax. And there are different levels of income tax you pay depending on how much you've earned in the year. So when you get paid, you usually automatically have tax taken out. So the gross amount represents your earnings before that tax is taken out. Tax is the money that's taken out, and net represents your earnings that hit your bank account after tax has been taken out. For young workers new to the workplace, you might find that tax is getting taken out, but you're not earning over $18,200 a year. This is why it's important to lodge a tax return. A tax return is your own end of financial year report. It tells the tax office how much you actually earned. If there has been too much tax taken out, you will get that money back. If there has not been enough tax taken out, you will have to pay it back. Sometimes you may need to make purchases that are related to your workplace. In these cases, keep the receipts, because you may find that you can claim these as tax deductions, meaning the amount of income you are taxed on is reduced, therefore paying less tax. You declare these deductions when doing your tax return. Now let's explain superannuation. Superannuation is money that you put away until you retire. When employed by an employer, you must be paid superannuation if you earn over a certain amount. This money is invested in a superannuation account, which can only be accessed when you retire. So when you get a pay slip, you're usually shown the amount that has been put away into that superannuation account for that pay period. Now that we've discussed the characteristics of a payslip, we'll now look at assets and liabilities. To understand these concepts better, we need to look at interest rates. Interest rates can be used in terms of growing money with assets or depleting money with liabilities. For example, an online savings account is an asset. So if you put $1,000 in there and the interest rate is set to 10% per annum, it will earn an extra $100 in the year. However, a liability like an unpaid credit card debt of $1,000 with a rate of 10% per annum means you have to pay $100 at the end of the year. These examples are extremely oversimplified because there's one more concept to take into account: compound interest. For our first example, if the interest is paid out every day, the amount that's earning interest is growing as it goes. So this interest accumulates and reinvests on itself over the 12 months. It's actually made extra money through compound interest. Although initially it doesn't sound like a lot of money, if you make regular contributions to this account, over time it will grow and grow as it reinvests on itself. So beware that this can also work against you in forms of loan and credit card debt, and these usually have much higher interest rates. So compounding interest can work for you or against you. The earlier in your life that you can start taking advantage of compound interest, the better. So this brings us to investing. Investing is using your money to purchase assets with the intention of making more money. Any investment has a potential risk and a potential reward. So let's look at shares as an example of an asset you could invest in. A share is a portion of a company. If the company performs well, the share value goes up. If the company performs badly, the share value goes down. So you could sell that share for higher than you bought it for, or lower than you bought it for, depending on how it performs. To reduce your risk in investing in the share market, there are assets called index funds. The ASX 300 index fund invests your money over the top 300 companies in Australia. This gives you diversification, meaning you're protected from one company performing badly, and your money is spread across other companies to avoid a loss. Another advantage of index funds is that there are low fees as the investing process is automated. But remember, there is no guarantee, and there is always a risk that these funds may not show positive results. Other ways of investing may be investing in property, where the return on investment comes in rent received or an increase in the property value. Business, where the return on investment may come in terms of profits. Or creative works such as songs or artwork, where the return on investment may come in sales or royalties. So just remember, not all assets lead to positive results. So ensure that you're putting in the right research and making informed decisions before you start investing. Liabilities like credit cards and loans are all about giving you access to more money than you actually have, and you pay this back along with interest. There can be a trap with loans and credit cards that you only have to pay a small portion of what you have borrowed back through the minimum repayment option. This actually means you are holding onto the bank's money for longer, and the more time that passes, the more interest you are charged. But beyond getting a larger debt through compounding interest, these credit cards and loans contribute to an unhealthy mindset by encouraging you to spend more money than you actually have, which is a bad habit to get into, and you can get trapped into always being in debt. Now let's look at 9 ways you can best manage your money. 1. Do your own tax return. In Australia, you can do your own tax return through the MyGov website. There may be some confusing questions, but the Tax Office website has helpful resources to support you understand. The more you know about the process, the more financially literate you will be. So encourage new people to the workplace to embrace the tax return process. If it is too hard for you, you can pay a tax agent to support you with the tax return. 2. Manage your superannuation. Superannuation is an investment. When you are young, it's hard to think about superannuation, an investment that you cannot access until you retire 40 years away. But because superannuation is a compulsory investment in Australia, you may as well get it right early so you can make the most of compound interest. Many mistakes with young workers going through multiple jobs is that each workplace has a default superannuation scheme that they sign you up to if you don't know what superannuation account you have. You can actually shop around and find the best superannuation account that you want. And once you have decided, you can merge all your existing superannuation accounts to your new one using your ATO online account. You should only have one superannuation account so you're not getting charged multiple fees. Remember, superannuation will keep accumulating over your whole working life, approximately 40 years, so that is a lot of compound interest to be taking advantage of. 3. Budgeting. You can track your financial situation by listing all your income sources and living expenses in a spreadsheet. If there are expenses that fluctuate like power bills and groceries, start tracking these, and over time you'll get a good expectation of the average expense. Once you have taken into account all your living expenses against your income, the amount left over is your discretionary spending, and it will truly show you how much money you have to play with. 4. Build a safety buffer. To protect yourself from the risk of running out of money to unforeseen circumstances like medical expenses or car repairs, you should build up what's called a safety buffer. This can be a saving account that you do not touch unless there is an emergency. Another way to protect yourself from risk is by purchasing insurance, particularly for vehicles and homes. If you have a family depending on you, you may want to consider life insurance, permanent disability insurance, and income protection. These are normally options in your superannuation account for more fees. 5. Increase your income. When you are earning income, you are essentially providing value to a business and getting paid in return. Think about how you can provide the most possible value to your workplace by working hard with a positive can-do attitude. This may lead to more shifts or promotion opportunities. Embrace the penalty rates. Working on weekends or holidays mean you are trading the same time for more money. If you do not see potential for promotion in your current workplace, consider looking to other places for more work opportunities. You could target your dream workplace by offering to volunteer, demonstrate your value, and this may lead to a fulfilling job opportunity. You can also think about side projects by monetizing your passions. For example, performing music or selling your artwork. In these cases, you can set up a one-person business called a sole trader and get an Australian business number. If you want to try it out first without committing to starting a business, you can operate without an ABN as a hobby or recreational pursuit. If you do make money from another business or a hobby, ensure you keep track of all your income and work-related expenses for tax time. Also, always be on the lookout for government welfare benefits and scholarships that you may be eligible for. 6. Reduce your expenses. Look at all your living expenses and consider the ways you can bring these down. You could look at reducing your tax payments. If you earn less than $18,200 a year, you may consider applying for the tax-free threshold, meaning you get little to no tax taken out of your pay. Does your bank account charge monthly fees? Most people settle for the bank account that they were set up with as a child, but there are banks out there that don't charge any monthly fees. If you do find a better deal somewhere else, tell your bank and they may be able to match it to save you the paperwork of going elsewhere. Plan your meals weekly so you are only grocery shopping once a week and making the most of all the specials. Consider moving into a share house to reduce the burden of paying rent. Reduce your power consumption by turning off power points and being mindful when heating and air conditioning and using hot water. Shop around for the best phone or internet plan and don't settle for your current provider. Again, if you find a better deal somewhere else, tell your current provider you are thinking of moving and see what happens. It can be daunting the first time you try this, but you are actually giving your current provider the opportunity to keep you, so it's win-win for everyone. Take advantage of loyalty programs, especially those linked to common purchases like groceries and petrol. Beware of subscriptions. We are now in a subscription society and you often have to subscribe to lots of different services for different things you wish to consume. So keep an eye on these and ensure you're using them all and be prepared to unsubscribe for the ones you're not using. Also watch out for delayed payment services like Afterpay. Although these can be really handy and free up more discretionary spending, the danger is if you overuse it, and then suddenly all these expenses keep chaining on and end up being living expenses, reducing the amount that you have every week for discretionary spending. 7. Pay off your liabilities. If you are in debt for short-term loans like credit cards or car loans, devote your discretionary spending to paying these off as quick as possible, even before you start building up a safety buffer. Because these debts accumulate and grow with compound interest, it's extremely important to get on top of these as quick as you can. If you are struggling with multiple short-term debts and credit cards, there are services that combine all these debts together and create one payment plan to help you get on top of it. A university student loan is designed to be paid off when you're earning over a certain amount of money, and it gains no interest. But do keep in mind that this loaned amount still goes up with indexation. A long-term home loan is usually set to 30 years and at a lower interest rate than short-term loans and credit cards. You could aim to pay this off aggressively, but this also may get in the way of life experiences that you may want to use your discretionary spending for. Where possible, get an offset account. In these cases, your savings is taken off home loan amount and you only charge interest on the remainder, but you can still get access to the savings whenever you want. 8. Invest in assets. Once you've minimised your debts as much as possible, you may want to consider investing. Many people who invest are working towards the ultimate goal of financial freedom, which means you no longer need to work or trade your time for money. To achieve this goal, assets need to be acquired which make passive income. That is, income that you do not have to trade your time for. Remember, each investment option has a potential risk and potential reward, so ensure you do your research before pursuing investments. 9. Value your time. The most valuable resource we all have is time. But remember, when we work, we are trading our time for money. So do what you can to make your job as enjoyable as possible. Try to align your passions and what you value in life with a career that fulfills these. There is a balance between saving for the future and spending what you want today. Create a bucket list of all the big ticket items you want to experience in your life and work out when you are going to tick these off and how you are going to save for these. These will give you tangible goals and ensure you are using your money to what you actually want to experience in life the most. When making choices on how to spend your discretionary money, get into the habit of evaluating how much value an item or experience will actually bring into your life, so you know you are making the best possible choices with your money. Thanks for watching this video and committing to being financially literate. There will be some resources in the description related to what we talked about today. Thanks and bye for now.